Saying goodbye to a tumultuous 2021, from the pandemic to cryptocurrencies, from inflation to meme stocks. This is a special year-end version of Bloomberg Wall Street Week. I'm David Weston. The smart investor had a lot to think about this year. Getting the economy growing again after the shutdown of 2020, getting back to the office, an increasingly assertive China, cryptocurrencies and meme stocks, a coronavirus that just won't go away, and, oh yes, the need to make profound changes in the way we all live our lives if we want to save the planet. Throughout the year, Wall Street Week brought together the best thinkers to go beyond the day-to-day and bring us a broader perspective. People like former Treasury Secretary Larry Summers.
We've put in motion, for the first time in 40 years, excessive inflation.
GM Chair and CEO Mary Barra.
The issues with chips, this is a short-term issue, and we'll work through it.
Ray Dalio of Bridgewater.
Think of the economy as being like an individual and their pulse is dropping.
Neil Ferguson of the Hoover Institution.
It's the Hotel California China style. You may be able to check in, but good luck checking out.
As we move into 2022, there is every reason to believe that all of the issues of 2021 will loom just as large in the new year. And so, to get a running start on next year, we look back, starting with something we address just about every single week on Wall Street Week throughout the year, the specter of inflation, starting with the founder of Bridgewater, Ray Dalio.
Think of the economy as being like an individual and their pulse is dropping. When the pulse is dropping, the doctors come running in with the stimulant and they inject stimulant. Now that the economy is rebounding, and inflation pressures are rebounding, there's not the same pressure to administer that stimulation. When it happens, when it becomes a problem, is first, the rising interest rates start hurting financial asset prices. First, typically, they hurt bonds. Then they pass through and hurt stocks because still interest rates affect stocks. And when that starts to affect stocks, that's one thing. Maybe the stock market can correct 10 or 15% and the Federal Reserve can tolerate it. When it goes beyond that and starts to affect the economy, that's when you see the real trade-off have to surface. So that's what that looks like.
No one at the Fed wants to be the people responsible for bringing back the 1970s. So I don't think there's that much constraint. And of course, this always comes back to this fundamental asymmetry. When interest rates are at zero, if fiscal policy falls short, then the Fed has a very hard time making up for that. If fiscal policy overshoots, the Fed has mechanically, they have very easy tools to use to bring it in. So now we're just into the question of some kind of mind reading. Do we think that the Fed is going to be afraid to do what's necessary should this turn out to be a really huge boom? And I don't, these are smart, tough people at the Fed. One of the institutions in American life that has really held up pretty well in all of the other chaos that we've been going through. And I'm not particularly worried that they will fall short on this front.
Inflation is a tricky concept because it's, people focus on one number. There are a number of cross currents. The labor dynamics are real. I mean, it's the hottest job market I've ever seen in history, and it's not going away anytime soon. There are not enough people. I mean, look at the amount of hiring that's going on from Amazon, the Walmarts, from the biotech companies, technology generally. So labor is going to continue to accelerate. The cost of labor is going to continue to accelerate. And then energy, some of the commodity infrastructure, it's hard to get the CapEx and to rebuild that in a short period of time. So some of those stresses are real, and the markets are going to focus on it.
Are we looking at a Volcker moment?
No, because you have to have a Paul Volcker to get a Volcker moment. Paul Volcker was a rare person and a great person. But no, that was what was it? 20 years of inflation accumulation, serious pressure on the dollar, serious question of the dollar as a reserve currency, and he stepped in to change the tide. We're at the beginning of a potential problem. And so we've got probably a few central bank heads before we get to that.
We're having it confirmed that it's not transitory. And I think everybody recognizes now, with the statements from Chairman Powell, with the statements from Secretary Yellen, that this isn't going to just go away of its own accord, that the Fed's going to have to take substantial action to control inflation unless there's some kind of other adverse development, a crack in markets or something of that kind. But we've put in motion for the first time in 40 years, excessive inflation caused by overheating of the economy, and that's going to have to be worked out of the system, and that's probably not going to be such an easy thing.
Well, let's talk about that, how easy it is. Steve, do you agree with that analysis? And if so, what are the prospects that, in fact, the Fed can slow this thing down without really causing some damage to the economy?
Well, I completely agree with Larry, and I think you have to recognize it's a problem that was not created in 2 months. It was a problem created over the last 2 years, and so it's going to take multiple years, certainly, to work it out. I in no way want to predict that we're going back to where we were in the late 70s, but I was sitting in the Washington Bureau of the New York Times when Paul Volcker announced his new inflation policy, and I watched all that happen, and it took multiple years and a terrible recession to get it out of the system. So it is going to be painful, and it's going to be painful for growth. It's going to be painful for jobs, and we do have an election coming next year, which is going to be complicated.
I think we're going to entrench inflation way above 2%, perhaps in the 4% or even higher range, unless something happens to break the current mood, to break the current trend. And I don't think it's going to be 3 rate increases or 2 rate increases next year. I mean, remember this crucially. Monetary policy today is far looser than it was a year ago. Looser as measured by real interest rates, looser as measured by financial conditions, looser as measured by the size of the Federal Reserve's balance sheet. So we've got looser monetary policy, even as job vacancies are way up, and even as inflation is way up as well.
That was Ray Dalio, Paul Krugman, Rick Reeder, and Larry Summers. Coming up, we move from inflation to the invention of a whole new means of exchange.
Every single big bank who's dealing with crypto or thinking about it, and fund managers, whether it's Fidelity or Goldman Sachs, needs to throw their weight around it behind this process.
Crypto and other digital currencies. That's next on Wall Street Week on Bloomberg. This is a special year-end version of Wall Street Week. I'm David Weston. One of the subjects getting the most interest this year was digital currencies, whether it's the crypto version like Bitcoin and Ethereum, or the move of some central banks to create their own digital currencies. Ishwar Prasad, Brookings Institution's senior fellow and Cornell University professor, believes that it's the technology that is transformative.
If you think about Bitcoin and then some of the newer meme coins that have emerged, which don't even pretend to have any underlying functions, it's clear that people seem to be relying on the greater fool theory, that if you buy this asset, you just need to find somebody who's willing to take it on at a somewhat higher price. But you know, David, the underlying technology of Bitcoin, I think, is what is really going to be transformative. And I think it's that technology that people are to some extent betting on. Because, you know, there are many frictions in international finance and domestic finance. Many people don't have easy access to digital payments. You know, in the US, you need a debit or credit card or a bank account to have access to digital payments. International payments are still beset by lots of impediments. They're expensive. They are very time consuming. It's very difficult to track payments. So there is a real need for better digital payments that people have access to without necessarily being well off. You need better international payments. So I think this technology is what might lead us to a world where, in fact, you can have payments being much easier, much more efficient, where everybody has access to them. And in addition, you might have better financial products and services, which really lead to the democratization of finance. But that is a promise for the future. It's not quite there yet. Right now, we have a lot more of the speculative risks rather than the benefits being apparent.
Regulators clearly need to start getting involved. I mean, the reason why someone like Elon Musk can have almost this Wizard of Oz-like effect on the crypto market is because it's opaque and unregulated and probably highly concentrated in its holdings. And there are efforts underway now amongst the regulators to exert more oversight, not just over the questions of market manipulation, but also money laundering. And frankly, every single big bank who's dealing with crypto or thinking about it, and fund managers, whether it's Fidelity or Goldman Sachs, needs to throw their weight around it behind this process big time. And ironically, green issues might turn out to be the issue that causes everyone to rally together, even the libertarians.
I think you have to start thinking about unbundling the sort of speculative aspect of crypto, which frankly has no value to it. And now we know it's dirty as it relates to the environment. And the actual value of crypto, which is a currency that settles immediately, instantaneously records a transaction, and lowers the cost of transactions in the world, and is the most valuable part. And so I think this might be, to Jillian's point again, the sort of start of unpeeling the onion between the speculative aspects, which frankly are not that valuable, and what the true value of crypto could be over time.
Some people think that if we move to a central bank digital currency, it may disintermediate our existing banks, that people will just have bank accounts with the Federal Reserve and maybe use the existing banks as service agents, but they won't have the same role they have in the past. Is that fair?
David, that is the number one issue central bankers worry about. It's the reason they haven't been rushing headlong into this. Everybody's thinking about, what coins the government can issue, that the banks issue deposits, but it's really the other side of the bank's balance sheet that concerns governments. Who's going to do some of the lending they do? We have all sorts of new things developing, through the internet, all sorts of new age ways of doing lending, but they're not matured. They're not regulated yet either. And I think as those things come into being, the governments may get less tense. I mean, will we have banks in 30 or 40 years as we know them? Quite possibly not. But the government is in no rush to have that happen overnight, and nor should it be.
Where does this leave the U.S. banks? An important part of the financial system in the United States, the strength of the United States. We had Ken Rogoff, the economist from Harvard, on Wall Street Week a while ago, and he said he thinks that it's almost inevitable that in 20, 30 years, U.S. banks will not look the way they do now. I think it's called disintermediation.
I don't personally predict the intermediaries going away. Where I do agree is that banks are going to change in some immense way, and they're going to look extremely different than they do today. And this is why the central bank digital currency, or CBDC, has to be done very carefully. But we go back to the central role of the bank, which is take deposits, make loans. Just as I don't see the Federal Reserve getting into the business of having a retail bank account with every American, I really don't see the Federal Reserve getting into the business of making home loans, and that kind of credit intermediation is going to take all kinds of different forms. We're seeing it with fintech, but people who have stable, regulated, reliable funding bases and are transmuting that funding base into credit products, that I don't see that going away ever. And anything that does that activity, looks like a bank, walks like a bank, talks like a bank, is a bank, even if you call it a fintech, and should be regulated as such.
Ultimately, for blockchain-based payments, that industry is going to do better, regulated in a sound way, rather than trying to be some kind of libertarian paradise. And I think the crypto community needs to recognize that and needs to work cooperatively with governments. And if they do that, I think that this innovation can be one of the important innovations of this period.
That was Ishwar Prasad, Gillian Tett, Ken Rogoff, Marty Chavez, and Larry Summers. Coming up, the drive to go green. 2021 brought a lot of talk, but how much real action was there? That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. This year brought us the Biden all-of-government approach to the climate and the meeting of world leaders at COP26. But with all of the talk, the question remained of the actions to follow. It looks like one of the first places we'll be seeing a real difference will be in how we get around. So we'll start our year-end review of the environment with GM Chair and CEO Mary Barra and the coming explosion in electric vehicles.
We think we're going to have a very positive year in 2021, not only from a financial perspective, but also the continued acceleration of our EV and our AV business. We're really excited that very shortly we're going to be launching the Chevrolet Bolt EUV, which is a great vehicle, and that's days away. And then, later this year, we'll be serving the market with the GMC Hummer EV, and then the Cadillac Lyriq comes shortly after that, as well as tremendous progress being made from an autonomous perspective as well. So we're really excited about the year, the growth opportunities that we have in front of us. And so it's a year of execution, and the issues with chips, this is a short-term issue, and we'll work through it.
How much help do you anticipate getting out of the government? We have a new president now, President Biden, who says he really wants to go to emission-free vehicles in the government fleet very quickly. He says he basically wants to replace them all over a period of time, create 1 million new jobs. Is that going to help a lot your move at General Motors over to electric vehicles?
Well, I absolutely think so. I think understanding EVs, understanding the importance, and really we have to work together. Business and governments need to work together to make sure we have a whole ecosystem that encourages EV adoption. We need to make sure there's the right charging, and that's why the work going on for infrastructure is so important. So we're having regular conversations with members of the administration as well as members of Congress to make sure they understand all the pieces that need to come together to support an all-EV future.
How do we avoid what's called greenwashing, a term that I'm only becoming familiar with, which, as I understand, is basically companies saying, oh, yes, we're green, but it's really more of a marketing thing, the way they present it, than actually in their conduct. How do we avoid that? Is it possible to avoid greenwashing, both for the government to make sure, but also for Bank of America as your banking companies?
Yeah, you'll be able to determine that. As I said, at the moment, we're using a third party, a TCFD, as our disclosure and greenhouse protocol as our measurement. But the truth is, transparency will be the key to eliminating greenwashing. If you write it all down and you express it publicly and allow third parties to take a look at it, particularly the advocates, I think you're going to see a reduction in the claim of greenwashing. One moment of just of clarity here is that for any company in its early stages, you can't really get all the way to, now let's begin with carbon neutrality, your own operations. We still can't get all the way there. Bank of America hasn't, and we have not seen many companies that have gotten there. They need something in the end called an offset. So you get 90% of the way, but you can't get 100%. And the last 10% requires some kind of offset, and you buy the offset, which is at the moment mostly forestation or projects, which is trees, forests, either building a new or retaining what exists, because obviously through your grade school science, photosynthesis and the expression of oxygen from the forest. Well, we need more than that to get there, because if every company in the world were to try to get to carbon neutrality first and ultimately net zero, we don't have enough offsets.
distinguish, if you would, defense from offense. And this is what I mean by that. It's one thing to say, if I'm working for a bank or an asset management firm, I'm going to really shy away from some of the fossil fuel companies. I understand that. I'll call that defense for a moment. But does this encourage companies to go on the offense, for example, to invest in green steel?
Look, David, absolutely. And that's the big shift here, I think, that we've been aware of the risks around climate, and the most obvious ones are, when New York gets hit by an extreme weather event and there's big property losses, or supply chains are disrupted by another event on the other side of the world, and we have those effects and we have to manage those. But there are huge opportunities in being part of the solution. And so the offense here is very, very broad. Of course, it includes, and in my professional life, I do a lot of this at Brookfield, one of the largest renewable producers in the world. It includes building out wind, solar, hydro, eventually hydrogen and other technologies that produce electricity with no emissions and are part of very much central to our future. But almost as interesting and really more valuable is going to companies that have high emissions today. You rightly mentioned the steel industry, or the auto industry, or the cement industry, the building industry, commercial real estate, others, and helping them get emissions down. Now, it takes a lot of capital in order to do that, but it's going to pay off in terms of a huge amount of value.
So we've heard these lofty goals. Everybody is signing up for them. But what does it mean in the real world? As you're doing deals, as you're managing assets, is it changing what you do?
On the asset management side of the business, absolutely. That's changing rapidly. On the advisory side of the business, which is arranging mergers and acquisitions, that's on the come, so to speak. We're seeing the beginning of it, but it's not quite there yet. Let me speak to the asset management side to begin with. One has to step back and realize this has been in play now for several years. The first thing that happened is the core demographic that drives activity in the economy started spending their values. That was, I don't know, couple of years ago, and 3, 4, 5 years ago in the United States, longer in Europe. Over the last couple of years, it has shifted now, so that same demographic is starting to invest their values. And that's playing through in the asset owners, and it's really having a big impact on the asset management business.
So when you talk about investing in assets, is it defense or offense? And by that I mean this. It's one thing to say, I don't want to invest, for example, in a fossil fuels company. Okay, I get that. But what about affirmatively investing in a green steel company?
I think in the beginning, it's going to be defensive, because at this moment in time, there's very little that kind of ties green performance, whether you are your emissions policy, your social policies. There's very little that actually ties that to performance in the stock market or cost of capital. That's at its very early stages. But scoring companies is there. So I'd say at this moment in time, we're probably doing, I would say most of asset management is investing defensively around ESG, and I think that's going to shift over time.
That was Mary Barra, Anne Finucane, Mark Carney, and Ken Jacobs. Coming up, it's the second largest economy in the world and on its way to becoming #1. We turn next to China, in a year when President Xi once again made his presence felt.
Let me put it really simply. Most of America understands that it's heading for Cold War. The part of America that doesn't get this is Wall Street.
Raising some tricky questions for investors. That's next on Wall Street Week on Bloomberg. China, the most populous country on the planet, has also grown its economy faster than anyone else in history. And although the pandemic slowed that growth in 2021,
the growth playbook has changed. And because the growth playbook has changed, we're going to be looking at much lower growth going forward. And it's going to be because the party is okay with that.
It still is the engine that drives much of the rest of the world economy. The Biden administration picked up this year pretty much where the Trump administration left off, taking a tough stance toward China.
China has an overall goal, and I don't criticize them for the goal, but they have an overall goal to become the leading country in the world, the wealthiest country in the world, and the most powerful country in the world. That's not going to happen on my watch.
But tough talk didn't slow President Xi in asserting his power over some of the big players in China, taking actions against big Chinese tech that wiped out billions in market cap with the stroke of a pen.
This Chinese leadership is so intent on exercising political control that they are even willing to pay something of an economic price for it.
Leaving investors to wonder how investable China really is at this point, something debated throughout the year. We start with Neil Ferguson of the Hoover Institution taking the under on that bet.
Well, I'm an economic historian. I take the long view, and you'd be mad to bet against the United States. You'd also be mad to bet on a totalitarian, highly centralized regime in a networked age. Let me put it really simply. Most of America understands that it's heading for Cold War. The part of America that doesn't get this is Wall Street. Money's pouring into Chinese bonds and stocks, especially tech stocks. Guys, I have bad news for you. They have capital controls. It's the Hotel California China style. You may be able to check in, but good luck checking out. So I think this is a really important long bet that Wall Street is making that is going to go very sour. And it could go sour too if there's a blow up between the US and China over Taiwan.
I guess by Neil Ferguson's definition, I'm mad because if I had to bet on one market or the other over the next several years, I would bet on China's. The yin and the yang of this is that in China, you're taking political risk. In the US, you're taking, in my opinion, economic risk. I think there are real questions around our economic policies now. There are real questions about our potential growth rate, our productivity, and so on. China is amazing. I haven't been there in a year and a half for obvious reasons, but it is the most extraordinary economic engine I've certainly ever seen in my life. But you're taking political risk, which is why the Chinese market trades at a substantial discount to ours, as well as to what it should trade at given its growth rate. But in the long term, with recognizing that there is significant political risk as an economic matter, I don't even think it's a close call in terms of where I put my money.
A lot of investors are looking at China really carefully and wondering whether it's time to maybe go neutral or reduce or take the feet off the pedal at the moment. Now, that may or may not make a big difference because foreign investors in China may only account, depending on which Chinese market you're looking at, anything from 5 to 25% approximately of the total market. So there will be an impact. And obviously, the Chinese want that foreign investment in their market, both private and public markets. But it's really interesting. I think the thing to me that was the most worrisome was not all the things we've been reading about on clampdowns. Maybe they do need better regulation of their stock markets and across the board, all the markets in China. But when they said they're going to start having government ownership in certain companies, whether it's Didi or others, it's sort of, I don't want to take it back to Putin and Russia, but it does remind you a little bit of a very different scenario. And that can be very, very worrisome if that trend continues. At the same time, let's not forget, as Rick was saying and you were saying, David, and a friend of the program has recently written, Dan Yergin, on supply chain problems, the ports, right? Whether you're looking at China, whether you're looking in California, our railways, they're all clogged, right? So regardless of what agreements are made between the two countries, those are not going away unless we have a really good infrastructure bill here and start building infrastructure. But that's going to take a few years.
There is upside potential. What we keep hearing over and over again, this mantra that China is uninvestable, says to me that there are some opportunities there, that there is some mispricing going on, and that if one has a long enough time horizon, if one is willing to wait this out, they could be very pleasantly surprised with China. Clearly, there are a lot of reforms going on, but I think we have a better handle on the areas of focus by China right now, and that certainly helps. And clearly, what China has done specifically with the property market has been somewhat calculating. When we think about Lehman and try to compare Evergrande to Lehman, I think it's incorrect because Lehman was a situation where regulators were asleep at the wheel. This time, we had regulators focused on improving the situation in the property market and creating casualties like Evergrande.
So, Rick, I think it's fair to say, you might well say, you can't get around China if you're an investor today. You got to deal with it one way or the other. Right now, do you think the risks in China are greater today than they were a year ago, less, or about the same?
So, listen, I think the uncertainty is higher. I mean, particularly you've got an economy that's decelerating pretty quickly. And, our sense is that most of that is temporary through the third and maybe into the fourth quarter. So anyway, that is higher. The regulatory dynamics that have played out, the uncertainty around, gosh, you've seen it in gaming, you've seen it in education, and some of those have, and the property sector, some of the reaction function has been unpredictable. And so, is the risk gone up? I think so. And I think general platitudes of I'm going to invest in it or not invest in it, or particularly not invest in it, I think is an extreme. I think as Christina said, you got to think about risk reward, how much, and scale your positions appropriately, and where do you have upside convexity? Some areas that it's just not worth taking the risk in China today. But I think having some patience where there's convexity to the upside. Listen, I think gave the number the other day. 26% of the unicorns in the world, real technology is developing in China. To be able to tap into some of that, with some patience and some staying power, I think makes some sense, even though we're at what is probably a riskier period of time for investing in China.
There are investors right now who are asking the serious question, is China investable at this point, given some of the things we've seen? When you think about investing, you've obviously got market opportunity in China. No one would deny that. Right. What about the political risk? During your time there, do you think it's going up right now or going down, the degree of political risk for investors?
Well, there's no question that it's going to be a bumpy road ahead for foreign investors, and that, as we said, while there may be some clarity around the direction that the Chinese government wants to go when it comes to whether it's market opening or the new regulations that they're taking, there isn't complete transparency on what the process is and the timing of any of the regulations. Take what we're seeing around the VIEs, these vehicles that are being used for many Chinese companies to actually get around the rules in China to establish overseas and then use that vehicle to invest. And that's the way that many foreigners are investing in the Alibabas and the other big companies in China. There was a rumor coming out of China that they were going to cut off that vehicle, which their regulatory authority has come out and said that's not true. But I am sure that what they're going to do is take a very serious look at what those entities look like and put some new rules around them. Because the whole intent of these VIEs was actually to get around the regulatory structure. So by their very nature, they need to bring some transparency and clarity to that. And that's going to make it very difficult for foreign investors to continue that route. And we're going to see more and more of these types of actions that, while in the big picture are understandable, perhaps from a Chinese context, for an investor, they're going to be unpredictable.
And finally, Deborah, maybe one of the big political risk questions, and that is human rights issues, because we saw this come up this week as Senator Mitt Romney really took on Ray Dalio, saying, how can you deny that there are real human rights violations? For an investor, put aside the morality of it just for a moment. For an investor or a company doing business in China, how does one factor that in? Is it a significant factor in decisions about how to go into China, how big to go into China?
I think the U.S. government has taken an important stance in its own set of values when it comes to voicing its concerns about human rights. For foreign investors, absolutely this is going to continue to be an issue. The Biden administration has stated very clearly that its expectation is that American companies will represent American values when they're overseas. How that is factored in is very complicated, because while American companies may take a stance, it's not necessary that all of our competitors are going to be taking the same stance. And I do think as part of this, we need to focus on what's the best interest of the American economy and American firms and American economic security, which is the basis really for our own national security. It's a very complicated question to factor in, but it's really a very critically important one.
That was Neil Ferguson, Steve Ratner, Afsaneh Beschloss, Christina Hooper, Rick Reeder, and Deborah Lair. Up next, we take a look at the markets overall.
We've had, just a Goldilocks period with both significant fiscal stimulus and even more significant monetary stimulus.
As they contended this year with COVID, the Fed, massive fiscal stimulus, and just watched valuations climb throughout the year. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Investors took in all the news throughout the year, watched trillions of dollars in fiscal stimulus pour in, listened to Chair Jay Powell and the Fed, and watch stocks go up. Through the year, we had some of the smartest markets voices come on Wall Street Week and try to make sense of it all, starting with Bob Diamond of Atlas Merchant Capital.
We've had, just a Goldilocks period with both significant fiscal stimulus and even more significant monetary stimulus. I think it's pretty clear now from what we've heard from the Fed that what we talked about, 2 or 3 months ago is that tapering is about to start. It's likely to go through the middle of next year and probably be complete. And keep in mind that the Fed has been buying, a lot of U.S. Treasuries and a lot of mortgages, and that's had a big impact on the yield curve and on interest rates. And I think it's in the market, David. I don't think anyone will be particularly surprised. On the fiscal side, as we've talked about, $5 trillion in fiscal stimulus during the COVID period. If there's not more fiscal stimulus coming after that, in essence, it's a tightening. So the market has to weather a number of challenges, but I think paramount among them is the beginning of the tapering. I don't think the market right now has factored in that the 10-year will be 2% or above. We've talked about this, but I think that 1.5% to 3% range has been the range of the 10-year for a long time, 10 or 15 years. Very few periods has it been below there. Recently, it's been below, above, as you said, just above it. We would expect tapering will be a part of this. Also, some of the economic surprises for the first time are coming out negative in all 3 regions of the world. So our expectation going into next year is that we're going to look at 2% or above in the 10-year.
We no longer have the ability to cut interest rates. We got plenty of ability to raise interest rates. And so, we're getting closer and closer to that day. And then the question is, how much of an interest rate increase and when? It'll be sooner than what's discounted, probably a lot bigger. If you look back historically at how much of an interest rate increase it takes to slow down an economy, it's like 300, 400 basis points. Wow. And that's in normal times when, and we have abnormal times because so much wealth has been created. It's nominal wealth. It may not be real wealth, but so much wealth and so much money is sitting in bank accounts that there's a lot of potential spending out there just sitting in bank accounts and sitting in assets.
Well, take me into that world. As you say, nominal wealth has been created. I mean, asset values have been increased, without a doubt. When in a world where you go up 300, 400 basis points, you take some of that value out of those assets. For an investor, where do you go to make sure that you don't get burned by that? Do you go offshore? Do you go to Asia? Do you go to China? Where do you go?
Well, I think first of all, you want inflation hedge assets because it's very likely that the rise in interest rates will lag inflation and lag the economy. The Fed doesn't really want to get ahead of it. Someday they might have to, but the first move up in interest rates is a rise in inflation as interest rates are dragged higher by the economy, and that doesn't shut things down. It just sort of resets the levels of everything. So first of all, inflation assets. And second, all of the things we're describing about the United States and Europe, they're not true for Asia. And we tend to have a very West-centric view of investing, and yet the economic output of what I refer to as an Asia bloc, which is China plus a number of countries that are trade very closely together, the contribution of that area to global growth is 2.5 times the contribution of the U.S. and Europe in terms of growth rates. If you look at the sizes of the cash flows, the size of credit outstanding, it's equal. And so I like to think in terms of balancing a portfolio between East and West, and of course, nobody's really even close to that.
The big question for us at Causeway is will the Fed tighten prematurely? In other words, will the Fed decide to rein in monetary policy and perhaps begin rate rises prematurely, choke off what could have been an explosive growth with all the monetary and fiscal stimulus that's occurred, in which case the economically sensitive stocks commonly found in value portfolios may not perform well. And that's one of the reasons why we made a huge effort to reduce our exposure, because the stocks had already priced in so much good news in areas like financials and industrials and materials, because they would be the most vulnerable.
So, Rick, what about that? What do you appraise the risk of their acting prematurely now? Some people thought they were sort of late getting to the party, the Fed, in addressing inflation.
Listen, I think the Fed, I think they could start tapering sooner than, I think they could start tapering right away. I mean, they're not going to do that. But the system is overstuffed with liquidity. I mean, to put $120 billion a month into the system is too much, particularly when the Treasury's general account has put $1 trillion in this year. So, listen, I think the Fed could go. And by the way, I don't think it will have any debilitating impact on the further momentum on employment. You know, when you look at jobs hard to fill, when you look at job openings, we're in an extraordinary period of time. We can't find enough humans for the jobs that are available. So the Fed's should go.
As an investor, particularly an equity investor, how do you assess the value in the Fed taking a little bit of air out of the bubble, if I can use that term, taking a little bit of the froth out at this point? Because there has been a lot of money sloshing around, as Rick says, and I think one of the consequences of that is there are some companies that are doing better than, frankly, they ought to, given the merits.
Well, just think about stocks as they should be priced at the present value of all the cash they'll generate into perpetuity, discounted to present at some discount rate. And that discount rate is very much a function of where risk-free rates are. And this is where equity investing has been a little challenging in the last couple of years because we've had negative rates, sovereign rates in some parts of the world, and we've had extremely low rates elsewhere. But as this normalization process occurs, with all this, again, it's not just the monetary accommodation, it's the fiscal spend that's occurred on top of it that is such an accelerant for economic growth. And to the degree that gets priced into rates, that should be excellent for those who use valuation as a method of stock selection.
So, Rick, given the fact that they've been expecting so much stimulus from, as Sarah says, not just monetary, but fiscal, really pouring into the system, does that create opportunities? Because some opportunities, whether it's on the fixed income side or the equity side, are undervalued, are actually underpriced.
Well, a lot of these stocks have
Sorry,
moved.
that was for Rick. Sorry, Sarah.
Yeah, okay. Sorry, you could take this one, Rick.
That's all right. So listen, I think the markets have done some real reevaluation of companies and presenting some real opportunities out there today. You know, I think, quite frankly, the markets tend to look at themes. You know, they were really hitting the technology, things like software. There's a lot of cash flow in some of the big established software companies, and it's been a great opportunity. Things like semiconductors and semiconductor manufacturers have come under pressure. That business is going to be on fire for a long period of time. And actually, we started to pick away a little bit in the last couple of days on some of the energy commodity that have come under a lot of pressure, because I do think you still have a tailwind that is pretty significant. We haven't had this dramatic overweight to those sectors, which have actually done pretty well. So we were picking away a little bit at that today. But anyway, it's healthy for markets to recalibrate. The markets, have gotten pretty overzealous in some areas. So I mean, I'm hoping, quite frankly, we get a bit more of this to put some money to work.
So, Sarah, same question to you. Where have there been values, real bargains, if I can put it that way, in the equity market?
Well, there aren't many bargains to be found, but the stocks that have lagged, let's put it that way, are in areas that have had no interest to investors. And so they are sort of appealing. Whereas I wouldn't want to be in the cyclicals. Most of them now, just as a broad category, a lot of them have fully anticipated economic recovery. And especially areas like autos and within the consumer discretionary category, where good luck buying a car, and they're expensive. On the other side, consumer staples, healthcare, especially pharmaceuticals, and utilities, so boring and so cash flow generative. That's what you want. Free cash flow now. So that's the cash that companies generate surplus to their needs. You can get that up front. That's a shorter duration stock, and that, in our view, is ideal in this environment.
That was Bob Diamond, Bob Prince, Rick Reeder, and Sarah Ketterer. Coming up, we take a look at the year ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We wrap up our look back at last year by looking forward to 2022 and what's coming up next year on global Wall Street. Starting with Juliet Sally in Sydney.
Thanks, David. One of the biggest events of 2022 we'll be watching is China's 20th National Party Congress, where we could see President Xi Jinping clinch a third term as leader, unprecedented in recent history. There'll also be elections in South Korea, Australia and the Philippines, as well as an upper house vote in Japan. The other key issue will be the reopening theme, as Asia has had some of the strictest border controls of the pandemic. And investors will continue to assess the impact of policy divergence as the PBOC looks to ease policy in the world's second largest economy. At the same time, the US Federal Reserve is preparing to tighten. Now over to Danny Berger in London. Danny?
Thanks, Juliet. Well, for the year ahead in Europe, we'll be watching really what most of the world is watching, and that's the evolution of the virus and the response from governments, both in terms of restrictions and fiscal stimulus. Now, at the same time, in Europe in 2022, we'll watch how the energy story evolves, the energy crisis Europe is facing with sky-high prices, and how that mix fares as governments try to transition to more sustainable forms of energy. It's also set to be a turbulent year for politics. Emmanuel Macron in France faces a re-election, and in Italy there's also a presidential election, and there's question as to whether the current Prime Minister Mario Draghi will run for that position as well. Germany at the same time has a new coalition, and they'll have to find their feet in 2022, and of course we'll continue to watch tensions between the US and Russia, especially as it pertains to Ukraine. Now let's get over to Romaine Bostick in New York.
Thanks, Danny. Investors next year will be keeping an eye firmly on the Fed. The FOMC has signaled 3 rate hikes for 2022 in what would be the first formal tightening of U.S. monetary policy in more than 3 years. And there's a lot of unfinished business on fiscal policy that will spill over into the new year. That includes another attempt by Democrats in Congress to advance Joe Biden's $2 trillion Build Back Better economic agenda. Also in Washington, keep an eye on a slew of regulatory proposals that may pick up steam. That includes antitrust actions at the FTC, a potential crypto crackdown at the SEC, and more oversight of buy now, pay later businesses at the CFPB. The oil and housing industries also will be a focus of Wall Street investors. Oil giants Exxon, Mobil, and Chevron have both made the U.S. shale Permian a key focus for the year ahead. Industry-wide, domestic shale producers next year are expected to increase capital spending to the highest since the pandemic began. And the resilient U.S. housing market faces a potential reckoning, as persistently high prices may have to be reconciled with a rise in mortgage borrowing costs. Home prices accelerating away from rents was cited by respondents in a Bloomberg survey as one of the biggest risks for 2022. David?
Thanks to Juliet Sally, Danny Berger, and Romaine Bostick. That does it for this year on Wall Street Week. I'm David Weston. This is Bloomberg. See you next year.